What's up, everybody? My name is Joe Brown and this is Heresy Financial. We just got the latest inflation numbers released for the month of May, and it showed the largest spike in inflation in 29 years. Now that's the core CPI. The CPI, which includes things like food and energy, is going to show an increase of even more than that at 5%. Despite all this, the Federal Reserve and many market analysts are still pushing the narrative that this is going to be transitory. And if we look at interest rates and stocks, it looks like the market believes it will be transitory as well. So we're going to dive into the details and we're going to look at number one, what are the specific things that are causing people to say and believe that this spike, the biggest spike in core inflation in 29 years since June of 1992, why are they saying this is going to be transitory? Number two, why they're wrong. And number three, what you can do about it. Ready? Let's dive in. Let's take a look at some numbers. The CPI is the Consumer Price Index, and you can see here that it had a massive jump in May. This is a more broad measure of inflation that includes more things than the core CPI does, and this jumped 5%, which the expectation was it would only jump 4.7%. And May's jump was the largest increase in inflation in 13 years. And then if we exclude food and energy, which the Federal Reserve usually likes to do because they say it's volatile, when really it just shows a little bit more of the inflation of things that people actually have to pay for. So who cares if it's volatile? That's something that people have to buy. That's part of the general level of cost of living. But if we exclude those to look at the core CPI, we can see that core CPI increased by 3.8%, which is larger than the expectation of 3.5%. And again, this is the core metric that the Federal Reserve usually likes to use, and this is the largest increase in core CPI since June of 1992. That's 29 years. Despite this, market analysts and the Federal Reserve are still very aggressively pushing the narrative that this inflation is transitory. It's temporary. It's going to go away. This is a very short-term spike. And the argument is predicated basically entirely on something called base effects. Now, if you don't understand base effects, I'm sure you've heard the Federal Reserve market analysts, the talking heads on CNBC say this over and over and over again. So I'm going to explain very simply what base effects are. When you say something increased or decreased, the question you have to ask is, compared to what? Let's look at gold, for example. If you say gold is down 9%, you have to ask, well, compared to what? Or compared to when, rather? And then if you're saying gold is down 9%, then your answer has to be, well, since August 6th, 2020. It's down 9% since then. And then you zoom out and look at the chart and you see gold has only been above its current price for a couple weeks in all of history. And August 6th was the top. Well, now all of a sudden, gold being down 9%, doesn't seem like that big of a deal because you're just comparing it to its all-time high. Similarly, if you say gold is up 300% versus the S&P 500 being up about 250%, again, you have to ask, compared to when? What's the time frame that we're looking at here? And then if you say, well, since November of 2004, you can say, okay, well, we picked that time frame, and yes, gold has outperformed the S&P 500 over that period of time. The bottom line is that time frames matter. And this is the argument that they're using to say that inflation is temporary, because when you say that in May, we had the largest increase in inflation, in core inflation for 29 years, in regular CPI in 13 years, you have to ask, compared to when? And these numbers, 5% for CPI and 3.8% for core CPI, these are year-over-year changes. And so we're comparing our current inflation numbers for this last May to May of 2020. So obviously you're going to have a massive jump in inflation if you're looking at May of 2020. That's why April was a huge jump in inflation. May, this month, is a big jump in inflation. And June, when we get the June numbers, will probably also show a large rise in inflation because we're comparing them to April, May, and June of 2020. So time frames matter, and that's the argument as to why people are saying, hey, this is transitory. Now we know that the market is on the transitory train. The market believes that this inflation spike is going to be temporary. All we have to do is look at stocks and rates. Market hit all-time highs again today, and interest rates are down. And we know the relationship between interest rates and bond prices are inverse, so that means people are buying bonds and buying enough of them in order to drive the price of bonds up, which is driving rates down. Now, real rates right now are negative. That means that when you factor in inflation, the interest that you're receiving on those bonds that you're buying is going to produce less purchasing power for you when you factor in the general cost of living increase. If inflation is 2% and you're getting 1% on your bonds, you're losing 1% total in purchasing power. And this is one of those sure signs that shows that the market believes that this inflation spike is transitory, it's temporary, that it's going to go back down. Because any free market participant buying a 10 or a 20 or a 30-year bond would not be doing so unless they thought that the current inflation numbers were going to go right back down. Now, I chose my words very carefully there because I said free market participants, so I'm not including the Federal Reserve here, who is a huge buyer of bonds, and that is definitely one of the reasons why bond rates are so low, because the Federal Reserve doesn't care about profitability. They're never going to have to care about purchasing power because they create dollars. And so as they buy bonds, they drive the price down, not caring what the inflation numbers are, not caring if they're getting a positive real return. They see their job as keeping rates low. And so this is another way that the Federal Reserve is trying to push this narrative to make sure that people think that the market believes the transitory narrative by showing, hey, well, rates are low. And so they're keeping rates low in order to try and basically trick the market into thinking, hey, if rates are low, then this inflation that is showing right now, it's got to go back down in the future. Otherwise, nobody would be investing at these levels. And so I expect rates, regardless of what inflation does, I expect interest rates to continue to stay subdued, move a little bit lower, bond prices to continue to go up from here. So let's look at the inflation index. What actually drove inflation higher? Well, the number one thing that has been influencing inflation lately has actually been used cars and trucks. And if you're in the market for a car or a truck, you've probably noticed this, but used cars and trucks, especially ones that are used, 2, 3, 4, 5 years old, are basically appreciating assets now. Who would have thought that we would see the day when you could make money on a used car or truck? Something that traditionally, you buy a new car, new truck, the moment you drive it off the lot, it loses value. Well, now you've got a 1 or a 2-year-old car or truck. You drive back on the dealership lot, you can get more back for it than what you paid for it originally a couple years ago. It turns out that when you put new cash into the hands of Americans, they're going to spend it. And Americans love their new cars and trucks. And I want to make a note about velocity here. This is the biggest misconception about inflation. You do not need an increase in velocity to have inflation. People talk about this all the time. They say, yeah, the money supply can go up, but if the money velocity goes down at the same time as supply is going up, they cancel each other out. That is not true. Think about this logically for a second. Take these 5 economic actors. We're making a fake economy right here. There are 5 people each selling something. They're each selling something worth $10. Now, in year 1, they each sell 2 of these things. They each make $20 because they sold 2 of something worth $10 each. GDP this year would be $100. Now, fast forward 1 year. They've each raised their prices. In fact, they've each doubled their prices. So now instead of selling something worth $10, they're selling something worth $20. But guess what? They don't sell 2 of them. They each only sell 1 of them. So how much money did each of them make this year? Same thing as last year, $20. GDP this year, $100. GDP did not increase. Money velocity, key to point out here, money velocity did not increase, but prices doubled. You do not need a corresponding increase in money velocity to see price inflation. An expansion of the money supply is the primary mover. It is the driver of price inflation. And wherever you see price inflation, you're going to be able to look at that and you're going to say, hey, well, this is due to supply chain issues, and this is due to X, Y, and Z, and this is due to predatory pricing and blah, blah, blah. All the fake reasons that they come up with. Ultimately, when you go back and dig a little deeper and trace them back a little bit further, you can see, oh, well, behind it all, we increased the money supply by 32%. That's going to have a little bit of an impact. And we have seen a historic increase in the total supply of money. And by all indications, that's going to continue into the future. And we know that there is a lag between when the money is created and when prices increase. But given what I've just said about how money expansion and inflation works, why isn't the CPI higher? Why is it only 5% year over year? Well, number one, like I just mentioned, there's a lag. So I would expect to continue to see this increase more and more and more. But number two, there are a couple of tricks that are implemented in order to mute the reported inflation numbers. And one of my favorite tricks that they use is called hedonic adjustment. This basically means that if by however they measure it, if the quality of something increases, they're going to measure that quality increase and use that to offset the amount that the price rose by. And one of my favorite examples of something that gets hedonically adjusted is men's pants. So let's say you just bought some new jeans at Costco. Last year when you bought your new pair of jeans, it cost you $20. This year, when you go buy your new pair of jeans, it costs you $30. That's a 50% increase in the cost of your pants. But wait, those new pants that you just bought are not 100% cotton this year like they were last year. This year, your pants have 3% spandex in them. They got a little bit of a stretch. That means that instead of your pants showing up as a 50% increase in the inflation index, it shows up as no increase in the inflation index because the quality got way better. It doesn't matter that the pants are going to last you the exact same amount of time, that they provide you the exact same amount of protection against the elements, and that they serve the exact same purpose and function and do not produce anything of value other than serving their function. It's not like something like a tractor that actually increases production value at a farm, or something like an increase in efficiency in a car engine that you have to spend less on energy now. Nope, just an increase in the quality of your new pants. So they use that to offset a certain amount of the inflation that would be showing otherwise. Now that's not the only thing. I'm not saying that it's all just deception and lies. There are some other things holding inflation back, and one of the main things right now is income. We just got the jobless claims and we got higher than expected jobless claims for this week, and companies are still struggling to hire. But we've got new stimmy checks starting next month as the child tax credit is going to be rolled out as monthly checks, monthly payments, and families that qualify will be getting up to $300 per month per kid. And so as incomes start to go up, whether that income comes from the government and from money printing or from jobs, that's going to be a tailwind for inflation, going to drive it up higher. So in conclusion, what does this mean for you and what can you do about it? Well, it means that the longer you hold on to dollars, the less those dollars will buy. If 2 years ago you were following traditional financial advice and you had a $1,000 emergency savings fund and you took that money out of the ATM, you have $1,000 cash in your safe, stashed in a box under your mattress at home. 2 years ago, maybe that $1,000 would have been enough to buy you groceries for 2 months, but now the price of meat and many other food items have been skyrocketing, and now if you go to spend that $1,000 on groceries, it only lasts you 1 month. You've got the same number of dollars. They just don't go as far as they used to. And so the number one thing that you can do to protect yourself against inflation is to keep your savings in gold instead of your savings in dollars. Because if you look at how much stuff you can buy with an equal amount of gold for thousands of years, the amount of stuff you can buy either stays the same or slightly increases. And if you want to avoid the scams, avoid paying high markups and high premiums, and you want the questions answered about whether you should buy gold in an IRA or have it stored in private storage or keep it at home, and what the best tools are for all of these things, I've got an ultimate guide on how to buy gold linked in the description below. Check it out. If you enjoyed the video, please hit that like and subscribe button. It really helps the channel out. And as always, I really appreciate you guys. Thank you so much for watching. Have a good day.